Hi, this is Rich Steinberg. I'm the Chief Market Strategist for the Colony Group, and along with my colleagues Brian Katz and Jason Blackwell, we've created this deck and outlook from you from Colony Investment Management. So today we're going to look at the 2020 outlook, and is there the visibility we've really been looking for? So we'll jump right into this right now. So thematically today, we're going to talk about that the economic outlook is improving. Assets are fairly valued, although some may be more fairly valued than others. And a really important point that diversification really matters, as does planning. So we'll dive right into the data right now as we speak. And let's start with the economy. It appears right now that the economy is a bit of a Goldilocks economy, not too hot, not too cold. GDP, or the economy here globally in 2020, looks like it could bottom out, and domestically in the U.S., the bottoming out could happen in 2021. If you look at this first chart on the top side, you'll see the dark blue kind of looks flat-lined all the way back from 2017, kind of going up and down a little bit, and the world tracks it around the same kind of levels. However, we don't see a recession as a major risk right now. On the bottom, you will see that dark blue line, that recession probability has been falling, and inflation remains historically low in that light blue line. The economy last year grew at around 2.3%, not too hot, not too cold. We probably need more, but probably won't be getting it soon. So the question really is, are we in an economic expansion in the mid-cycle part of that expansion, or in the late cycle? The headline growth figure from last quarter was around 2.1%, which was a little bit firmer than the market was expecting, but some of the underlying trends do appear soft. So the question will be, will political and geopolitical landscapes taint the porridge? We're not sure, but we doubt it. And in a low economic environment like this, and with low volatility, we think that we could kind of trudge along here. We are starting to see some issues around the coronavirus in China, with some global GDP slowdowns, and it's something we're watching. What does this really mean to you? It means that we're going to slowly kind of continue to move out of the kind of the economic slow growth rut that we've been in. Very importantly, on this next chart, employment remains low. You have to realize that 2/3 of the U.S. economy is driven by the consumer, so people that have jobs buy goods and services. I'm not saying they shop till they drop, but we are looking at a place where the consumer is extremely healthy. You could see the light blue line all the way low. That's the unemployment rate, which is at historically low levels, even below 2000. And payrolls, which are the dark blue, have been holding up nicely. In a tight labor market like we have, manufacturers prefer cutting workers' hours to layoffs, so that may be part of the equation. And strong labor markets continue to boost household confidence. So as we move along, in the consumer confidence side, like I said, this is a 2/3 of the economy. Sentiment remains strong, and wealth on the bottom, you can see household wealth versus income is extremely high. Strong labor markets, like we just saw, will boost that confidence. And the question will be, will we see any improved consumer spending? We are seeing a little bit of the consumer slowing, but it's not contracting. But those household assets as a disposable versus disposable income are at record highs. Think of that as like a wealth effect. Oh, my house is going up, I'm doing better. Those are the kinds of things that keep confidence high. And we're continuing to watch the University of Michigan Conference Board, which is a big measure of sentiment, to see if it's starting to plateau. But on average, we're not seeing it. To give you some background, on average, consumer confidence plummets roughly 1 year before recession, and obviously that has not happened yet. So all the indicators look okay for us avoiding a recession, in the near term, and that's because the consumer remains quite healthy. But let's talk about recessions a little bit. While we do not see one, what causes recession? Well, it's changed a lot over time. So if you look at this chart in the 50s through the 70s, there was a recession that took place, ups and downs, called the kitchen cycle. That's a short business cycle of about 40 months. It was discovered by Joseph Kitchen in the 1920s. And this cycle was believed to account for by time lags and information movements that affected decision-making of commercial firms. As we moved into the 70s and mid to late 80s, a lot of the recessions occurred by double-digit interest rates as well as energy shocks. If we remember, both energy crises really caused damage to the economy. As we moved into 1990, we had the bursting S&L bubble in the early 90s. We had the tech bubble in the 99-2000 range, and of course the Great Recession in 2008 where housing burst. We are not seeing any asset-like bubbles right now. Some are percolating a little bit that we're watching with some concentration in the S&P that I'll talk about later. But overall, we do not see this as a risk. Please keep in mind that we can guarantee that at some point we will have a recession. That will happen. The question is when, and we will be prepared for that, and we'll hopefully have data that will help guide us and your money along the way. As we turn into the next charts here, we talk about where uncertainty lies. This first graph on the top left is the uncertainty index. It has come down a lot. And the bottom chart is really important. That's the uncertainty tied to CapEx spending. What's CapEx spending? It's capital expenditures by industrial and corporate business decision makers. And we've definitely seen that as an issue in this economic cycle. Business sentiment is trying to recover, but the hits keep coming from political and policy uncertainty, and we really need business confidence to improve for capital expenditures to reaccelerate and help extend the business cycle. Remember, trade disputes and Boeing's production issues damage the manufacturing sector, although the manufacturing sector now is way smaller, a smaller share of the economy than it's been in the past, but it does create a big share of the volatility. Some uncertainty was improving. We had the U.S., Mexico, Canada deal proceeding, France's digital tax truce, and the phase one of the U.S.-China trade deal. That may be set back somewhat by the pandemic scare with coronavirus. We just don't know yet. We are seeing some concerns that it could slow down growth, and the proof will be in the pudding. If we look back at past pandemics in the future, in 2001, Uganda had a large Ebola outbreak. There was a SARS crisis, swine flu, the MERS, the Middle East respiratory syndrome, and other outbreaks that we've seen before. So we have to just see whether or not this will temporarily slow things, or if there'll be a catch-up after, God willing, this virus gets taken under control. In general, supply chain impacts are still undetermined, and the response from companies will be maybe more drastic in the past. A lot of that is also how quickly information and people move throughout the world. So this next chart is quite important to us. This is a chart of the U.S. Treasury curve. The black curve on top is where the Treasury market was in 2013. We plotted three different yield curves. The darkest line, that is what a normal yield curve looks like. It's steep and upward sloping. The blue line is where we were at the height of the yield curve inversion in August. And the middle line is where we were at the end of last year. While it's steepened, it's not normal. However, if we take the Fed at their word, we should not expect much movement. And so we expect this 2% rate to stick around into 2022. Remember, as populations age, they tend to become more risk averse and invest in fixed income, but we're watching this closely. The Fed appears to be cutting rates, but with the recent crisis in China, there may be room for some insurance to cut if inflation stays low, but we hope the Fed doesn't use that right now. So this next chart, even though there's no pictures of the bad guys or bad actors, this is some of the things that keep us up at night: Russia, Iran, ISIS, Syria, North Korea, China's role in their Belt and Road Initiative, which involves billions of dollars of projects in over 100 countries in railroads, land, marine. They're lending money, and in some cases, those countries can't pay them back, so the Chinese are taking them over. And if you are somewhat skeptical, you could think of that as a long-term disruptive force. Let's not forget Venezuela. And I think these are things that we need to just be thinking about in geopolitical risk and other world events that could affect the portfolios. We've lived with these for a long time. So for your portfolios, we've navigated these over long periods of time. So where's the market going? Equity valuations are fair, but some are fairer than others. The graph on the top represents the emerging markets, the S&P, and the world markets. It appears that the world markets and emerging markets appear a little bit cheaper historically than the S&P, but we'll have to see whether or not the excess liquidity that I just talked about in lower rates forces people into riskier assets. What does that mean? If rates are so low, you might have heard the expression, Tina, there's no alternative to cash. So will people go up the risk level to add equities in a portfolio that might not necessarily should have it due to age and cash flow needs? We do have expectations for greater economic growth outside of the U.S., which could lead to divergence in earnings growth between international and U.S. names, but I think we'll have to just kind of wait to see what happens. Of the companies that have reported so far, 69% this quarter have beaten bottom line EPS numbers and 64% have beaten top line numbers. These numbers are relatively strong, but there's still a lot of companies that are going to be reporting in the quarter, and we'll just have to see how earnings progress and how earnings seasons progresses. One of the things you have to realize is in this chart, from 1970s to about 2006 or 7, we were in a period where every 4 years, international would outperform domestic, then they would pass the baton to the other, and it would go back and forth. Since 2007 until recently, there's been a 12-year cycle where the U.S. has outperformed. We think that cycle may start to slow down or change, and that's why we remain invested not only in the U.S. markets, but domestic markets. Diversification across geographies is really important to long-term success. Even though international assets haven't done well over the past decade, we do think that there is a chance as the economies turn that we could end up in cheaper markets internationally than we have here. S&P return expectations are low for next year, and I want to walk through this chart a little bit more than normal, and I'll try to keep it so we stay on track. Essentially, most analysts are looking for about $178 in earnings for the S&P. So I'm going to give you 3 scenarios: a bullish case, a neutral case, and a cautious case. Essentially, if investors feel that interest rates are low and they're willing to pay more for the earnings like they did last year, you could see a 3,500 level on the S&P, which is about 6 or 7% from these levels. If investors are willing to pay what they paid last year, we're pretty much at full value, and investors will kind of run in place. Granted, there'll be volatility up and down, so there'll be an ability to make some money as money gets deployed and cash gets deployed. but we're at levels that are pretty decently priced at these levels. Sometimes markets trade above the neutral case, so you don't need to panic that we're at full value. On the cautious side, if earnings don't come through from either economic slowdown or the coronavirus becomes a bigger issue or earnings disappoint, we could see a lower level of about $171 with a little bit lower of a PE than people are willing to pay just to be cautious, and that would give us about 6% downside or 3,000 to the S&P. Last year, earnings came down, but investors were willing to pay more, so you actually had earnings come down. The really important thing to realize is over long cycles, earnings matter, and markets get priced to earnings. So that's why we're presenting a bullish, neutral, and cautious case. Investor sentiment has risen somewhat, and in some cases, there's been some extreme optimism. As an example, in the S&P 500, 5 stocks represent almost 18% of the S&P: Apple, Microsoft, Google, Amazon, and Facebook. So clients need to realize that when we're investing, our clients don't eat an index; they eat an outcome. So there are times when the S&P may have greater risk, and you could be rewarded in a bullish environment or a risk-on environment to riskier parts of the S&P, but having mid-cap and small-cap in the portfolio, as well as international and emerging markets and bonds, help smooth the ride. And I think it's really important for us to remember that there were other periods in 2000 and the tech go-go days, before the Great Recession in 2007. Financials were a huge amount of the S&P historically. So these are some of the things that we're watching closely. But in a low interest rate environment, in a low inflation environment, we could continue to support higher than average equity valuations. So there's no need to completely redo your asset allocation unless you have cash flow needs that come with it. And this next chart is probably one of the most important. This chart goes all the way back from 1980 to 2019. The blue marks are the annual return for the S&P, and the little black dots where you see them are during the year how much the S&P might have fallen intra-year before finishing. So what does this show us? It shows us that you have to be in it to win it. Yes, are you going to have certain drawdowns like in 2008? But 30 of the last 40 years, we've had a negative return intra-year in the market, and the market has finished positive. So this is the case where as the S&P or equities in general are risk assets, you have to be willing to ride through some of the ups and downs in order to capture the long cycle. And I think this particular chart really sums that up. But let's be realistic. Diversification has been disappointing recently because the S&P has really outperformed international markets in the last 12 years. People start to focus only on domestic. But if you go back 20 years, the total return of the S&P was about 224%, and a diversified portfolio actually beat it at 235%. So that portfolio has small, mid-cap, international, emerging markets, and other components in bonds that help smooth the ride. So diversification is not dead. It's just taken a little bit of a pause versus domestic versus other markets, and that's okay. Global fund managers started the year overweight commodities, which has not worked out yet, but there is a place for commodities and other asset classes in this portfolio. As we move along, planning really matters, and we know that you speak to your wealth advisors regularly. I want to explain this chart a little bit. So this chart is around life expectancy, and it's come from both the Social Security Administration and work that we've done here at Colony. So we have a plan for long spending periods in retirement. And according to this data from Social Security, if you look at a single female, which is the light blue, has a 73% chance of living to age 80 and a 34% chance of living to age 90. For a husband and wife couple, the odds are either living to 90 or almost 50%. So long-term really matters. We think about our grandparents and our great-grandparents that didn't live as long, and we're really seeing this longevity now. So we need to tie the risks of the cash flow needed and assets needed for clients to long-term life expectancy. That pretty much finishes up this presentation. We're always happy to answer questions via your advisors. If you have questions on this or want more data, please reach out to us. It's always a pleasure to speak to clients on matters like this.